Hello, my name is Eddie Tofik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of Paris milling wheat, Minneapolis wheat, and London UK feed wheat. Paris milling wheat. There had been here one continuing dominant pattern for quite some time. A quite large pattern that 14 weeks ago took a break on the downside. It is of course the dark blue highlighted late August 24 to late February 25 ascending triangle pattern. This pattern had the requisite combined 5+ touches and is made up from a lot of smaller patterns within it. But the main pattern can clearly be seen on my daily chart. 15 weeks ago I laid out targets below for this pattern. I quote, the primary target X would be in the 226 zone, with a secondary high to reach target X1 down in the 194 zone, end of quote. 14 weeks ago the market reached the primary target X, pushing down below it. However, we had a stall in the movement lower during the first part of March, prompted by the market trying to test down towards the 50% absolute Fibonacci line at 219. Now please remember that 219 level and the 50% absolute Fibonacci line, as it will come up again soon. This action back then became very crucial to what happened next, beyond the obvious significance of it being a 50% absolute Fibonacci line. You see, it had importance because this level helped hold up prices back in November and early December last year, and also eroded the bearish incentive back in August and September last year as well. The reactionary rise we saw in March only managed to move up to the gold long moving average overhead, currently at 226, not even testing it. Well, it's no longer gold anyway, but it's the long moving average overheads at 226, not even testing it, but rejecting further upside pressure. And we dropped lower after that, more or less down to lows that we have not seen since March last year. Anyway, 14 weeks ago I amended the still open further targets below into secondary hard to reach target at 205 and a tertiary target X2, an even harder to reach target down at 194. I asked a question back then, and I quote, question still remains as to whether prices will take this time to form a possible bearish halfway hesitation, or will they recover further. The latter seems unlikely right now, and the former, well, is too early to say, though it might comply with what is going on in the other grain markets, end of quote. I added 8 weeks ago, and I quote, comply? Well, the market did, as we've dropped down through the 50% absolute Fibonacci line and shown a new close-in target X4 for the bearish halfway hesitation down in the 206 zone, which I have since finessed to the 208 zone. This is the most immediate opportunity on the downside, end of quote. 6 weeks ago prices reached the target at 208, and 3 weeks ago they reached the target down at 205. This just left that tertiary and much harder to reach target X3 down at 194 still open. I am usually loath to downgrade or retire patterns or targets. I suppose this is due to my conservative nature, but I am now considering retiring the final and ultimate target X2 below at 194. It seems it is increasingly out of touch with what has been going on since May. In more recent action, 2 weeks ago prices pushed up through the 50% absolute Fibonacci line at 219, remember that one? And the green short medium moving average currently at 214, and even the May 23 low at 221. However, by last week it was clear the market had not managed to stabilize over any of them. We are back today resting just above the congestion on the downside at 211, and again pressing the bright red, unreconstructed and seemingly significantly breached, though even now I'm not sure I would call it fully broken just yet, March 24 today uptrend currently at 214. I think I may have to finesse that one soon, but not when it is acting as such a market attractor as it is now. Further up, the medium moving average is entering the frame, and prices overall remain below the 50% absolute Fibonacci line. If these can be truly broken on the upside, then it would be a proper new development, given a whole new series of market dimensions to contemplate. However, the congestion below and the gap that follows lower down to 205 are still nearby, and I do not wish to ignore them, not just yet. Keep an eye on this big gap below, and overhead on the 50% absolute Fibonacci line, plus the overhead declining medium moving average and the long moving average above that, which I say is currently at 226. Minneapolis wheat. We have one key pattern to look at here, and a number of newer patterns and levels to discuss as well. The key patterns, the previously highlighted sideways triangle, created by what is now the dark blue July 23 to May 24 downtrend, which I have unreconstructed, it's currently at 603, and the bright green early March to mid-May uptrend. After some hesitation over the last few weeks, prices finally pushed lower 4 weeks ago, down to the slightly realigned September 2019 to date uptrend, currently at 573. This was all before a changeover gap moved prices back up again. Now, there is no bearish halfway hesitation to consider here, as seen elsewhere, nor is there a 38.2% absolute Fibonacci line nearby, as that is down at 537. So it was a straightforward attempt lower, though we also had support down there, down at 578, and in the congestion between November 24 to January 25, between about 585 to 611. In the end, prices did not manage to reach the targets below, and I have retired them both today. The subsequent move back up from the September 2019 uptrend hesitated for a bit in late May, resting just over the medium and long moving averages, currently at 613 and 615 respectively, and creating a small bullish halfway hesitation that this past Monday reached its target on the top side. In the process, prices have pushed up over the April 24 low at 635, and now eyeing the overhead August 28 high at 650 plus the nearby congestion at 652 and the 2025 high made in February at 659. In fact, we are moving over a lot of that already as we speak. This action this week could be seen as yet another small bullish halfway hesitation with potential up to the 650 area, which would be nice. Once there, we will have to contend with a high for 2025 made back in February, just under 660. London UK feed wheat. There continues to be here on this daily chart, even now these many months, close to 1 year even, only one major significant pattern here, something we have not seen in the other grain markets, and that is the bright red, late May to early July 2024 bearish shift pitchfork. The market in late February this year reasserted the dominance of this pattern, with prices breaching, then repairing an attempted break higher over the bright red upper time, currently at 173 even, back in late January and early February. Add to this the earlier this year narrow mix overhead of all the moving averages, though they are now separating out, as well as the 50% absolute Fibonacci line at 180.5, and you had, and I suppose still have, an area overhead that, as I've repeatedly said for months and months, that had been brewing up for a significant move, which happened, or should I say started to happen, over late February and into March. I had been, as I said 25 weeks ago, and ever since, and I quote, even now still looking for that better pattern to appear, and until that shows up, I'll continue utilising the bright red bearish pitchfork, end of quote. Now, so my point has been, and it still is, that the bright red bearish pitchfork was and is, after all these temptations of all the other patterns, still the only one key pattern I was looking for all the time in the first place. This leads me to my final 4 points, and 3 of them were for something that I noted on my recent annual, well, not so recent, annual commentary on London feed wheat. Firstly, I saw there the potential for a very large May 23 to date cat's ears pattern. This is a bearish pattern, akin to a double top formed over a big fall, such as the fall we had earlier in 2023, as well as an even longer term second pattern, an August 2020 to date, very large head and shoulders top pattern. These two super long term patterns are still alive, and they both rely on one single feature, and that is their common neckline, on my daily chart currently at 167.80. For most of March, prices slid along the top of the support from these pair of necklines. However, recently we dipped, recovered, and then again 6 weeks ago dipped again below the neckline, setting up the opportunity for a recent bearish halfway hesitation. Potential target down at 151 even zone, at the same time making the lowest lows and low closes since March last year. Unfortunately, time is running out for this target X down at 151 even. I may well retire it soon, unless I see a constructive move lower, and I mean by soon as well. The third feature is a little more longer term. It is the March 2016 to date, twice recently finessed, dark blue uptrend, currently at 154.45. So for the last few weeks we had the market pressing on the necklines as well as the earlier version of this uptrend. I said 5 weeks ago, and I quote, "It looks right now as if we are finally breaking below it, as well as pushing down through the congestion between March to April 2019, between 161.95 to 165 and 3/4, end of quote. Well, we finally did push below it, as well as below, for the first proper time since July last year, below the bright red middle time, currently at 155.20, though we've since stabilised above it, and I've spent most of the last 3 weeks there above it itself. We do have support below at the February 24 low at 154 even, which held prices up 2 weeks ago, and the March 24 low at 153.65. I did say 3 weeks ago that it would be interesting to see how the market treated these two, and it was, as we saw 2 weeks ago, it was to be a weekly key reversal up, right at the lows of the market. However, there's been no follow through higher since then, with prices staying within the body of the earlier weekly key reversal up. Now, going back a little bit, I've said here repeatedly that there was one major, possibly severe criticism of the two necklines, and that is they had been previously breached and some would argue broken. However, I countered that by saying that I transposed these from my longer term monthly charts. And whilst on a daily and even on a weekly chart they may appear breached and broken, on the longer term monthly charts they are really live. They did look somewhat valid, and as I've also said repeatedly, and I quote, "I would not take these as cast iron lines in the sand that should not be crossed, but as longer term strategic patterns that we should bear in mind and occasionally bring a closer eye upon, such as now," end of quote. I added 5 weeks ago, and I quote, "This week is the first week in quite a while when I really think we have broken the back of this support. We have not only had a significant monthly close below these key necklines, but we also did it with a monthly key reversal down. Now, 1 month does not make a major change in my monthly charts, but it does set up the situation to see if May and even June will follow through lower," end of quote. Watch this space, end of quote. But at the moment, I still stand by those words. Watch this space. Thank you for listening and watching this broadcast. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. The copyright is Eddie Tofpick and ADM Investor Services International Limited. And here comes the final important bit.